Hello and welcome to Investing Confidential. I have 7 charts that you must see before you start allocating any money here in 2023. I'm going to show you those charts in a few minutes, but first, I want to make some comments about this week's action and really focus on the tech sector here. I mean, the unemployment data came in today. I don't know if you saw it, but it was hot. Market was down quite a bit. I mean, what this basically shows, look at the data here. Okay. What we have here is a very tight labor market, confirming this data actually is legit. This data is inflationary. Okay. Labor market, they say, is tight. The Fed looks at this data. The Fed's going to stay the course. They're not going to pivot or lower rates in this kind of environment where the data is telling you that the labor market is tight. So forget about pivots. The Fed's going to stay the course. Rates are going higher. A bullet came out today after the close saying the same thing, that rates are going to stay significantly higher, over 5%, and that's the bottom line. So don't expect any help from the Fed. Do not fight the Fed. Rates are going higher. I mean, just on the data. I mean, the data is skewed by California and this population mobilization, which we're seeing, continuing to see. Also people are still that are unemployed are still not being categorized as unemployed. That's the way I think I explained it in one video. The data is the data, but the way they gather the data is a joke. And a lot of people have already run out of their insurance, unemployment insurance, so they can't apply for anymore. So this is why the data really doesn't make sense. But again, the Fed's following this tight market data, so you got to pay attention. You can't fight the Fed. So let's talk about tech a little bit here. Tech's been getting killed. If you watch videos over the last few months, I've mentioned at least a number of times. I warned you about Apple. Apple is very vulnerable. It's happening. Everything I said is happening about Apple. Apple stock's getting killed. Their market's blowing up. They tried to manipulate you and tell you that they didn't have enough phones for the Christmas season. That was a lot of malarkey. It's all about demand, folks. Not about supply. It's about demand. And I'm going to link some of the Apple videos at the end of this video. But Apple's still in trouble. Okay, their exposure to China is pretty significant, both on the demand side and the assembly side. Actually, yesterday China came out with some data about smartphone demand in China down 30%. Okay, let me repeat that. Demand for smartphones down 30% in the largest smartphone market in the world, which is China. Okay. And so what's happening? Demand is falling all over the place in Europe, the United States, China, the 3 biggest economies. And what's happening? It's forcing the tech companies to adjust. Okay, they hired like morons. Now they're firing like morons. They're firing into a downturn. Some of the talking heads, told you on Monday, hey, buy tech. And these guys are, if you listen to these idiots, you just, forget about it. You'll lose so much money, it won't be funny. But these layoffs are accelerating, as you can see here. Okay, started with Amazon, and now you're seeing across the board. And it's not going to stop, okay? These tech companies are too top heavy. They need to start cutting people out. And because, again, it's about demand. They thought this crazy demand from COVID was going to go on forever. It doesn't. And boom, this is what's happening. So, but again, the talking heads don't get it. They keep telling you, oh, this is a time to buy. This is not going to affect the economy. These guys are out of their minds. Of course, it's going to filter into the economy. These are high-paying jobs. People are out of work. For a while they'll survive, but eventually they're going to try to get new jobs, and they're not going to be able to make the kind of money they did before, and it's going to affect the economy. Okay, so look what's happened to tech companies. It's all about fund flows here, folks. Take a look at this. This is devastating. Okay, this is the largest outflow from tech funds in 30 years. Okay, 30 years. Look, this is incredible. Okay, this is leading to massive underperformance. Look at the FANG. Okay, it was something that was a theme for a while. Look at the underperformance of these FANG names versus the S&P. I mean, massive. Okay, FANGs outperformed for a while. Now they're getting killed, and this underperformance of tech is going to continue. Okay, so let me get to these charts now. So here's 7 charts you have to take a look at before you invest in 2023. And I'm going to warn you, they're not bullish. Okay, the first one is very interesting here. Let's take a look at real assets versus the real economy since the great financial crisis. And as you can see here, if you own stocks since March of 2009 when the market bottomed, you did very, very well. Any kind of financial asset, you did extremely well. Bonds, stocks, everything. Okay, up until maybe with the exception of commodities, as you saw here. And the real economy, well, if you were working as a regular worker and everything else, you didn't do too well. Okay, you didn't do too well at all. You had a house, the house underperformed, everything underperformed financial assets. So if you were part of that financial asset where you had a lot of money and you made a killing since the great financial crisis, but regular people, 98% of the population, you know, didn't do anything. Didn't feel that big move, well, that's why we have this massive wealth gap today. But let's take a look at it now. So here you have 2022, okay, since January. It's been a massive reversal. The real economy, wages, etc., leading the financial assets, with the exception of commodities and gold. All right, we look at gold breaking out here. We'll talk about that some other time. Real economy, especially when we talk about wages and obviously inflation, all of this stuff. It's just the beginning. Okay, as we saw in the previous chart, we had 12, it was 12 years of outperformance, 13 years of outperformance. Okay, are we going to get? And again, what this is Main Street versus Wall Street, folks. This is what it's all about. So Main Street should begin to outperform Wall Street over a long period of time. That's not good if you have all your money in stocks. That's what I'm saying. These charts, they're going to tell the truth. So Main Street will outperform Wall Street. So you got, low end wages, middle end wages will hold up, will go up, whereas stocks, bonds, all financial assets should see significant movements downward. So the next chart here, we're going to look at, again, wages or labor as a share of GDP. This is pretty significant. Okay, so since the 1950s, labor compensation has been, lockstep, or sometimes outperforming corporate profits. Obviously, we saw a big divergence in the, late 90s, early 2000s. Corporate profits massively outperform real wages. And but things are changing dramatically. As you can see, there is an uptick here. So you're going to see labor compensation begin to move towards corporate profits. And what does that mean? That means margin contraction. Okay. And this is not good for stocks. Okay, this move, we looked here in this chart, the big move in margins, big move in corporate profits versus labor, great for margins. But now here you can see we're seeing the reversal. The problem is that margins currently are at all-time highs. Okay, and this is Goldman Sachs data and other data. I mean, the bottom line is, I believe, as this chart is saying, that we are at all-time highs and margins are going down. Okay, it's obvious. We're seeing this on a global basis. Okay, not just Europe; it's in the U.S. Everything. We're going to see margins begin to contract across the board globally, because again, all this globalism. We got a global economy, and everyone is vulnerable, and this means also you're going to have contraction of multiples. So let's take a look at multiples now. Here we have, across the board, all the regions around the world, the US, the globe itself, and emerging markets, Europe, et cetera, et cetera. As you can see here, the US still very overvalued versus its 20-year timeline here. US is trading at the high end of the range, 17 times earnings. It's down from what was way above that, but it's even with this correction, we're still at 17 times earnings. And within its range, it's at, again, versus the world, it's very high. If you want to look at, undervalued countries where you see good valuations, you got Japan and you got the United Kingdom. Okay. And, if you look at the United Kingdom, you could look at something like EWU, or for the ETF for the UK, and EWJ for Japan. So if you're looking for someplace that is cheap relative to the US, you can find that in those two names. And now we come to, I guess, what is the second to last slide here, inflation adjusted. We look at peak inflation here We had of 8%. And what does this mean? What does this chart mean? Basically saying as when you, whatever your peak inflation is, you're going to get a PE contraction. So if we look at over on the left, we have 7 to 8%. With current P's at 17%, we're going to see, PEs drop between 12 and 13%, which is actually the average PE normalized over time. So, and this data goes back to the 1900s. Obviously, you can see that. So the bottom line is this: we're going to see margin contraction, we're going to see PE contraction, and we're going to see earnings contraction. And folks, that is a recipe for disaster. So despite the massive market move to the downside in 2022, we're going to see more of the same in 2023. I couldn't tell you when things are going to begin, but I think we've already seen the beginnings of what's going to be a very rough year. And the final sort of chart slide here is, I think I mentioned this in I definitely mentioned this in one of my previous videos about China, to watch out for this. Okay. China is easing mortgage rates for first home buyers. Okay, first, as we discussed, the Chinese real estate market was the engine of growth for 25 years. They pounded into the ground. They tried bailing out the banks, didn't work. They tried bailing out the mortgage companies. They tried bailing out some of the developers. None of that worked. The only thing that's going to work is getting the consumer energized. Okay, and by easing mortgage rates for first home buyers, what they're saying to the Chinese consumer, it's time to buy homes again. This is very positive for the Chinese consumer. I think we're also seeing this. The Chinese government basically gave up on COVID. They've opened up. People are dying. People are getting sick. Chinese government just doesn't care, and they opened it up. And as what happened in our society when we opened up, we had a big move in the market. I think we're going to see the same thing in China. As you can see here, FXI versus RYT, which is our technology. And FXI is very tech heavy right now. Over the last 7 years, massive outperformance by the US, RYT, our US technology. And then look at now in this last year, you're seeing a reversal. I think we're going to see a beginnings of this FXI, which is the Chinese, really the only way to really buy Chinese tech outside of buying Alibaba, JD.com, etc. Big outperformance versus our own tech company. So there's some ideas. You got tech, you got the UK, you got Japan, but overall in the US, it doesn't look good, folks. Okay, so if you're an investor, be careful out there.